Last week I turned £100 into £300 and we managed to 300x the account. I've received a lot of questions from people asking, how do I trade Forex and how did you turn £100 into £300? So today in this video we're going to be going over how you can trade Forex in 2025 and how you can turn £100 into £300 and even more, just like me, simply by trading Forex. So the first thing you guys need to do is download two apps. The first app is MetaTrader 5 and the second app is TradingView. Now TradingView is where you guys will be able to see the charts, and it is where you guys will be able to see the candlesticks and all of the pairs. That is where you guys will analyze the markets and see whether you want to buy or sell. MetaTrader 5 is actually where you will be entering your positions and hitting the buy and sell button. That is also where you are going to calculate your risk and see how much you want to trade and how much you want to gain. So TradingView simply looks like this. You've got a bunch of charts and candlesticks here. You've got your pairs along here, and then you've got extra widgets along the side. At the top here, you guys can see I'm currently on the GBP NZD pair. I've got my time frames here, the 15-minute, 30-minute, 1 hour and 2 hour, which I call the lower time frames. And then you've got the 4-hour, daily and the weekly, which I call the higher time frames. I actually look at the 4-hour, daily and weekly to know whether the market is bullish or bearish. And I use the 2-hour, 1 hour, 30-minute and 15-minute to make my entries. Then along here, you've got your indicators, alerts, and you've got replay mode. I don't use any of these options here. Here, you make sure you guys always save your charts. You've got a few other things along here. The only two I really use is this, which shows me the pairs, which this is basically the icon for my watch list. And then this here is the icon for my alerts. Along here, you've also got your drawing tools on the left side. This star at the bottom actually shows you your drawing tool, so it hides and shows your drawing tool. If you want to add more things into your drawing tool, your favorite tools over here, you can actually click on one of these on the side, click arrow, and then just star it. And as you guys can see, I've just extended my favorite tools. Over here on the watch list, personally, I use all of the Awanda markets and charts. So all you have to do is click on the plus icon here, go over to Forex, and where it says all sources, click that and just look for Awanda, which is here, and then it will show you all of the pairs for Awanda. And as you guys can see, I've got Euro USD, GBP JPY, GBP USD, USD JPY, and so forth and so forth. Now every weekend what I do is I look for the higher time frames. I go over to the weekly, I go over to the daily, and I go over to the 4-hour time frame and see if price is bullish or bearish. Now this here on screen is what the charts look like. As you guys can see, price was going up. This point here is what we call the higher high. Price went down but never broke below this point here. So this point here is what we call the higher low. Price then went up and broke above this point. So now it is the new higher high. Price went down but never broke below this point. So now this new point is the higher low. Price then went once again, broke above this previous point. So this point here is the higher high. Price went down, never broke below this point. So now this point here is the higher low. Price then went up but never broke above this point. So this is a lower high. From here, price went down and broke below this point. So now this here is the new lower low. Since price broke below this low, it is a lower low. And this previous point here, if we retrace that up, that becomes the lower high. So if you guys look at the charts, every move the chart makes is creating higher highs, higher lows, lower highs and lower lows. This point here was the lower low. Price went up but never broke above this point. So this is the lower high. Price then went down again. So this point here would be new lower low. Now if price broke above this point here, above this lower high, then this point will be the new higher high as price broke above this. If you guys have a look, this is the higher high, price went lower but never broke below this low, so it's the higher low. Price went up and broke above this previous higher high, so it's the new higher high. If you look here, price had a lower high and a higher low. Price broke below this higher low, so now this H turns into an L and we have a lower low. Price broke below this lower low here, so we have a new lower low. If we retrace that back up, this is the new lower high. Price broke above that lower high here, so now we have a higher high. All you guys need to understand is where we are creating higher highs and higher lows, we are in an uptrend market and we are bullish. The moment we break below one of those higher lows, we become bearish, so the market moves bearish. Now, as you guys can see, price here created a lower low, that was the lower high, that is the new higher high. So now once again we are in an uptrend going bullish. Bullish means uptrend, bearish means downtrend. So the market here was bullish and the market here was bearish. Once again the market went above, so we are bullish. Once you guys download MetaTrader 5, you need what is called a middleman, and that is the middleman between your money and the markets, and that middleman is called the broker. Now, good brokers offer very low spreads of about 0.1 to 0.5 pips and low commission, low spreads and low or no swap fees. The brokers that I've used are Owanda and Black Bull Markets, so you can go ahead and use them as well. Personally, I'm not affiliated with any broker, so I can't recommend any. I can just say that I have used Owanda and Black Bull Markets and like them. There are also other brokers like IC Markets and Vantage and other brokers as well. If you guys would like to know what brokers there are out there, you can actually go on TradingView and find them. One of the free trades that I took to turn that £100 into £300 was GBP CHF. So if you go onto your watch list and type in GBP CHF, I obviously use the Owanda ones, so I'm looking for the Owanda broker, and you just click the plus here and it gets added into your watch list here. So I'm using GBP CHF and I can see on the weekly time frame price was going up, down, creating a higher low, went up, creating a higher high, a higher low, a higher high, higher low, higher high, higher low, higher high. Then we created a lower low as we broke below this point here. Then price never broke above this point, so now this is the lower high. Price broke below the previous lower low here, down to here, so now this is the lower low. Since then, price has never broke above this point, so the price is still bearish on the weekly time frame. On the daily time frame, you guys can see that price was in an uptrend as we were creating higher highs and higher lows. Then we shifted structure here where we create a lower low. Shift of structure is basically when you go from an uptrend to a downtrend or a downtrend to an uptrend. So when you go from bullish to bearish or bearish to bullish. Now, as you guys can see, price went here, created a lower low, created a lower high, and then a new lower low down here. And since then, price has never broke above this, so we are still bearish. On the 4-hour time frame, price was creating a lower low here as we had a higher high, higher low, higher high, higher low, higher high, higher low, higher high, lower low here as we broke below that previous low there, lower high, and then a new lower low. And since then, price has not broken above this previous lower high, so also on the 4-hour we are bearish. If I show you guys my analysis, the weekly is bearish, the daily is bearish, and the 4-hour is also bearish. Next, what you guys want to do is find your key level of support and resistance. Now, support is basically where price taps into an area and goes to the upside. Resistance is when price taps into an area and goes to the downside. This black box here represents my area of interest. Area of interest. Now, the reason I call it area of interest is because price can tap into it and use it as support, or price can tap into it and use it as resistance. So this is my area of interest. Now, the area of interest I look for is either on the weekly time frame, the daily time frame, or the 4-hour time frame. If we go over to the charts over here, you guys can see that on the daily time frame we have a key level of resistance where price had resistance here, resistance here, resistance here, and resistance here. Before I show you guys how I took my trade on GBP CHF, it is clear for you guys to understand a reversal pattern within the markets. Price will always create higher highs and higher lows, lower lows and lower highs, but to understand when the market is going from bullish to bearish, you guys need to understand what a head and shoulders pattern is. A head and shoulder pattern is simply when price creates a shoulder, a head, and then a right shoulder as well. So price was bullish, price came here, created a low, this is the lower low, price here went up, so it created a higher high. Price then went down but never broke below this, so this is the higher low. Price broke above this higher high, so this is the new higher high. Price went down but never broke below this, so it is the higher low. Price went up but never broke above this or below this, so it is the lower high. And then price broke below this over here, so now we have a new lower low. Now what this is a reversal pattern, as you have a left shoulder, a head, and a right shoulder as well. It's the left shoulder, the head, and the right shoulder. Now within this left head, right shoulder, we actually have what I call an area of interest. And an area of interest is an area where price has used the left head, right shoulder as support. Now if you look at the legs of the head, you guys can see this leg and this leg. Now if I draw a box along that, you guys can see that price broke through that area, retested it, used it as support, and went to the upside. You guys can see price retested it again and went to the upside. Price then went down, broke below it, and what normally happens is price will come into the area, retest the area here, and head back down to the downside. And what that is basically doing is the break and retest of the area of interest. It is breaking the area of interest, retesting it, and then heading to the upside, or breaking through the area of interest to the downside, retesting it, and then heading back down to the downside. Break and retest can look one of two ways. You are either breaking through the area of interest to the upside, retesting it to head back up to the upside, or you are breaking through the area of interest to the downside, retesting it, and then heading back to the downside again. Now on GBP CHF, as you guys can see on the 2-hour time frame here, we have the left head and the right shoulder. If I show you guys, you've got the left shoulder here, the head, and then the right shoulder as well. Now left head, right shoulder is a clear pattern. I always love to use this pattern as it tells me that price is now going to reverse. As you guys can see here on the left head, right shoulder, you've got this as the neckline of the left head, right shoulder, which is also the area of interest. Neckline, area of interest, support and resistance, these are just different words, different terms for the same thing. It's just simply a box. Now if I go over to the 1-hour time frame, you guys can see that left head, right shoulder more clearly, as you guys have the left shoulder, the head, and the right shoulder here. As you guys can see, price broke through that area of interest, retested it as it came back here, and then went back down to the downside. I made my entry when price broke here. I waited for a pullback into this area around here where I expected price to go back down from, and as you guys can see, price went back down from this area of interest as expected and went to the downside. Now to enter a trade, you need to know where your stop loss is and where your take profit is. Stop loss is basically when price hits that point, you will lose your trade. Take profit is when price hits that point, you will win your trade. Now for this trade, my stop loss was above this point here because I knew if price broke above that, we will just continue heading to the upside. And as you guys can see, if I extend this, price broke it here and just continued to go to the upside. Stop loss is important to have, because if you don't have a stop loss, you can lose the entire balance of your account. Take profit is the price where you want to get out, and since I was using a 2-hour area of interest, my 2-hour take profit was down here, which was actually hit. As you guys can see, your take profit needs to be hit as well, because price is not always going to be bullish or bearish. As you guys can see on the 4-hour time frame, if I had bought here, my stop loss would be below here, around there, and my take profit, if I didn't set one, eventually I would end up getting stopped out at this point here. However, if you set a take profit, I know I'm making 8.7 risk to reward. Risk to reward is basically how much you're risking and how much you're making. So if on this trade I risked £100, I would have made £170. Risk to reward and risk management is key, because risk management is what makes you a profitable trader that makes money and makes money consistently, and a non-profitable trader who loses money and blows accounts. If you have clear risk management, you will always make money and can use forex trading as a source of income. If you do not have good risk management, you have to rely on other avenues of income. I have personal accounts, and for my personal accounts I risk 1% per trade. What that means is if I have £100, every trade I am risking £1 or £2. If I have £1,000, I am risking either £10 to £20. I am always risking between 1 and 2% of my balance. It is clear that whatever you risk at the start of the month, you should risk that for the entire month, because if you change your risk, you are going to increase your losses and decrease your profits. Now let's say you take 3 trades and all 3 of them are a buy. If you risk 1% on the first trade, 2% on the second trade, and 3% on the third trade, you are likely to make no money, simply because if the first trade wins, you make 1%. Now if on the second trade you also win, you've made 2%, so overall you've made 3%. However, on the last trade, if you enter here, price goes up but then goes straight down, you've now lost 3%, which means in these 3 trades you've made no money. However, if you risk the same amount on all 3 trades, so 1%, 1% and 1%, if price here you enter and goes up, guess what? You've made 1%. If price here goes down, you've lost 1%, and if price here goes up, you've made 1%. If you hit take profit here, stop loss here, and take profit here, you are still a profitable trader. Why? Because you were up 1%, back down to break even, so you've lost nothing, you're back down to where your balance was at, and now you've just made another 1%. So out of those 3 trades, you've made 1%. You are still profitable as you've increased the balance on your accounts. This is why it is important to risk the same amount every single day for the whole month. You know what bullish and bearish means. You know what the time frames look like. You know how to analyze charts. You know where your areas of interest are, because all you're looking for is some sort of support and resistance. A clear level of support and resistance on GBP CHF will be here, where you've got resistance, resistance, support and support. All you're looking to do is draw a box along those lines. If I find a random chart here, you guys can see that this whole level here, it is support, because price went up, price went up, price went up, and price went up. Now if price breaks below this point here, I know it is now going to be used as resistance. So now you know your areas of interest as well. All you need to know is when to enter a trade. Now to enter a trade, all you need from your area of interest is some sort of confirmation, and that confirmation will be an engulfing candlestick or a shift of structure. Now shift of structure, like I said, is when you go from bullish to bearish or bearish to bullish, and a engulfing candlestick is one candlestick that is bigger than the previous candlestick. If you guys have a look here on GBP CHF, this is my area of interest, because I've got resistance, resistance, support and support. I know the weekly time frame is bullish and the daily time frame is bullish, so I'm looking for buys at this level. This candle here represents an engulfing candlestick, so I've got an engulfing candlestick. Price here had a lower low, so this previous point here was the lower high. And if I mark that across, you guys can see that that engulfing candlestick broke through it. So now we are creating higher highs and are in a bullish market and in an uptrend market. So all you need to do is enter the trade here, because you've got a shift of structure off of your area of resistance. You've got an engulfing candlestick off of your area of resistance, and all your time frames are telling you to buy. I would buy here off of the next candlestick. It is always important for this candlestick to close, because this candlestick could have easily rejected this area and gone straight down there. So it's always important to wait for the candlesticks to close before you hit buy or sell. My stop loss would go here, because I know that if price breaks below that, we are now using the area of interest as resistance, and the 4 hour will end up being bearish. My take profit would be at a previous high right here or here, and if I had done that, I would have made a 2.96 risk to reward here, or a 3.44 risk to reward here. One thing that you guys need to understand about these candlesticks is that they always have a body and a wick. So the body is this inner box that is colored. It will either be red or green, and the wicks are the lines that go either to the down or to the top. Every candlestick must have a body and 2 wicks. If it does not have a wick to the upside, the next candlestick will form the wick to the upside. If there's no wick to the downside, the next candlestick will form the wick to the downside. As you guys can see on this candlestick here, there was no wick to the upside, but there was a wick to the downside. The next candlestick created a massive wick to the upside to compensate for not having a wick on this candlestick here. So it's important to know what bodies and wicks also look like. I hope that is enough information for you guys to understand how to trade and how Forex works. All you guys need to do is download MetaTrader 5 and TradingView, find a broker, deposit your money into the broker, and use them as a middleman between your MetaTrader 5 and the charts. You need to put the money in, look at the market, see if price is bullish or bearish, so either in an uptrend or a downtrend. Find an area of interest, which is also support and resistance. Find that area of interest, wait for price to tap that level of area of interest, and then wait for your confirmations. You go down to the lower time frame and you wait for a shift of structure where price is reversed from bullish to bearish or bearish to bullish, or you wait for an engulfing candlestick, which is a candlestick that is bigger than the previous 1, 2, 3, 4 candlesticks. Good luck to you guys who are out there trading and learning how to trade. If you have any questions, feel free to comment down below and I'll take my time to answer those questions in depth so you can understand how to trade. Wish me luck, as I am on the 100 to the mil journey, where I'm turning £100 into £1 million in just 100 days. We are now about to enter week 2, so if you haven't seen week 1, make sure to go check that out, and make sure to check week 2 out the following weekend.